International Conference on Accounting and Finance.
I'm Samangi Bandaranayake from Department of Finance, University of Colombo, Sri Lanka. Today I will be presenting my paper based on the impact of ownership on commercial banks' profitability in the Sri Lankan context. This is the outline of my presentation: introduction, literature review, the research problem, methodology, findings of the study, and finally the conclusion. Let me begin with the introduction. The sound and profitable banking system contribute to the stability of the financial system. This is something which is very common with the banking practitioners as well as with the researchers. It's mainly because with the recent financial crisis as well as with the Asian financial crisis, we realize the importance of soundness and the stability of the banking system and how it directly impacts to the entire financial system of a country. And in the Sri Lankan context, if we refer, as at end year 2013, commercial banks account 48% of the total assets from the entire financial system, which means it's something close to 50%. Major portion of the assets owned by commercial banks, then they have a significant role in managing the financial system stability. So the commercial banks play a leading role in the Sri Lankan context. So it's vital to see their profitability and whether any other factors which can influence to the bank's profits. And in the Sri Lankan context, we can identify three types of banks based on the ownership: state-owned banks, private-owned banks, which are listed, commercial banks, and foreign-owned banks, which are the branches of foreign banks. And in literature, we found out the return on asset is the most common proxy measure we can use to evaluate banks' profits compared to other profitability measures. Most of the researchers use this measure as an indicator to show profitability, and the main reason is ROA captures interest returns as well as non-interest returns. From the bank's point of view, interest return as well as the income generated from none other main financial activity. Mainly they are dealing with savings they obtain from the customers and the advances they provide to their customers. So ROA captures both these aspects, so it's something very important we need to consider when determining the bank's profitability. And furthermore, micro-level factors, which means internal factors within the banks as well as macro factors, are also creating an impact to the bank's profits. Literature provides evidence equally important. Micro factors as well as macro factors are equally important. And if I consider about the micro factors, operating expenses, capital adequacy of the banks, and the asset quality or the loans and advances quality, and the bank size are the main important factors which can create an impact to the bank's profits. If we take the operating expenses, banks always try to reduce their operating expenses, then as a result of that they can show a high profit. And the capital adequacy, when their capital is strengthen the capital, they have the chance of operating smoothly without any problem. And the asset quality, if they have strong asset base with quality loans and advances, if they can recover them within the given time period, then it also shows banks' profitability and it could create an impact. And bank size, large banks have the more chance to generate more profits. Those are the results from previous research findings. And when I move on to the macro factors, interest rates, the economic growth, and the regulatory requirements are the key variables which can create an impact to the bank's profits. And furthermore, the ownership, the type of the ownership the state-owned banks, private banks, and the foreign banks. It also could create an impact to the bank performance, and in the other countries there are research findings. The ownership is a key variable which can show an important impact to the bank's profits. And there's another finding, ownership is irrelevant. So we need to find whether this ownership can create an impact in the Sri Lankan context. So based on that, my research problem is, does the ownership impact on commercial banks' profitability in the Sri Lankan context? My methodology mainly follows the sample period is from 2001 to 2011, 10 years time period, with the selected sample of 14 licensed commercial banks operated in Sri Lanka. It includes 2 state-owned banks, 9 private commercial banks, and 3 foreign bank branches. And panel data regression was applied in order to undertake the study. And I have considered macro factors as well as micro factors when developing the econometric model. ROA is taken as the proxy measure of profitability, and the micro level factors are cost income ratio to show operating expenses, capital adequacy, loan loss provision, bank size, and non-performing loans. Those are the 5 selected variables to capture the micro aspect, and macro aspect from the GDP growth rate, statutory reserve requirement, and the prime lending rate. Those 3 variables are taken into consideration to capture the macro aspect. And this results indicate for different subsectors, the state, private, and foreign banks, how the macro factors and micro factors influence to the bank's profitability. If you can see the 3rd row, the cost income, which shows the operating expenses. It is the common variable to all 3 subsectors. The significant variable which we can apply to all 3 sectors. And in addition to that, all the other variables are not highly significant for foreign bank branches. And if we refer the state banks, most of the variables are highly significant. And findings of the study are a negative relationship between ROA and cost income for state, private, and foreign banks. It confirms the previous research findings. The banks aiming at increasing profitability are more concerned about lowering their operating cost. Always, banks try to reduce their operating cost, and with the saving, they can improve their profits. And it confirms in the Sri Lankan context as well. And high capital adequacy for state banks increase ROA. If I refer the previous slide, the capital adequacy, if you refer the 2nd row, it's significant for the state sector. The state banks, it's a significant variable, and it confirms the previous research findings also. According to previous findings, state banks have the capital strength. The government backup helps banks to sustain within the business, and with the government support, banks are generating profits. So in the Sri Lankan case also, it confirms. Bank size and the loan loss are significant determinants and positively influence on ROA of state banks. In the Sri Lankan context, bank size of the state banks. From the total assets of the commercial banks, 2 state banks hold more than 60% of the total assets. So their size is comparatively high compared to private banks and the foreign bank branches. So the bank size is an important indicator. And the loan loss provisions made to loan losses is also a considerable factor in the Sri Lankan context. Furthermore, non-performing loans is a significant factor for private and state banks. private banks as well as state banks in the Sri Lankan context, they are targeting more low-income population of the country, because to attract their customers, their target is that. Due to that, they have high non-performing loans, and it's a significant factor which can influence on banks' profits. So for the foreign banks, they have good high quality asset base, the high clientele. It is not a important factor for the foreign banks. And the selected determinants are significant for state banks, except the prime lending rate. All the other variables are highly significant for the state banks, and state banks' profitability is mainly influenced by macro factors as well as micro factors. And from the results, it evidence the determinants are not highly significant for foreign bank branches of the Sri Lanka. And when I consider the explanatory power of the variables, for the state bank subsector, the explanatory power or the R squared is 0.927, which is somewhat significant compared to the other two subsectors. For the private banks, it's only 0.463. It's a significant level, above 50% rate. But for the foreign sample, it's very low, it's 0.16. So very poor explanatory power for this macro and micro factors for foreign bank branches. So it indicates that ownership of the bank is an important factor in the Sri Lankan context. It's relevant when deciding the bank's profit. And macro factors as well as micro factors will change according to the ownership. So finally, the conclusion of my study is the macro and micro level determinants change with the ownership type, and in the Sri Lankan context, state banks are highly influenced with these macro and micro level factors, and there is an impact from the ownership on commercial banks' profitability in Sri Lanka. Thank you.